Good afternoon, everyone. Thanks again for joining us for our Green Energy Metal Conference. My name is Chad Gilfillan. I'm Senior Vice President of Investment Banking of Red Cloud. Joining us live from Cobalt, Ontario today, we have Trent Mell, President and CEO of First Cobalt. I'm sure he's got lots to say about the refinery that's sitting behind him in the backdrop, as well as some new developments at First Cobalt and the cobalt market in general. So Trent, without further ado, I'll pass it over to you.
All right, thank you, Chad. Hi, everybody. So before I start sharing my screen, where I am standing in one of the upper platforms here in the refinery. This is the refinery that was built in '96, hasn't operated since 2015. And so we've got a lot of people here now. There were a dozen or so trucks and vehicles when I arrived this morning. Lots of crews in. Our owner's team, we're now at probably 7 full-time people. Behind me, far side, is the part we're going to reutilize. About 50% of the equipment and tanks here goes into the main plant. About 25% of this stuff is going to be used for battery recycling. So a lot of opportunity to salvage what's here as we go from a small operation that was once 12 ton a day to something that's going to be 50, 55 tons a day. So tell you more about it, but I am up here anyway, so I thought it'd be fun to broadcast from the refinery proper and just give you a bird's eye view of what we're doing. So I will just share my presentation here full screen and I'll jump right into it. We don't have a lot of time. There will be, of course, some forward-looking statements. So here we go on that. And summary. So if you don't know the company, 2 big assets. It's the refinery that I'm standing in, and it's our Iron Creek copper cobalt project in the state of Idaho. So we're Canada and the US. This refinery is 5 hours north of Toronto. It's previously operated, it's permitted, and despite our name, this is not a cobalt refinery, it's a battery materials refinery. In the past, it produced cobalt, some copper product, nickel, silver, not battery grade, but we're reutilizing the permits, the flow sheet, some of the flow sheet, it's hydrometallurgical, so it's got near zero emissions. And the site infrastructure is basically what we're leveraging to convert this into a much larger facility, initially cobalt, shortly thereafter, battery recycling. And if I look even further, we see opportunities here for nickel. And you get those 3 pieces together, then you could see precursor manufacturers setting up near us as well to create a larger center of excellence. And we had a press release out today that talks a little bit about that. I'm going to focus today on the next really 12 to 18 months to get us to cash flow, and we can talk about that at the end if you like. So first piece, here's the refinery from the outside. Lots of land, and if you look around, if you look at what we're going to be building, we're going to add a second building to the right of the current refinery for solvent extraction. We need a low impurity, very high grade cobalt sulfate product. So the SX plant is going to be a slightly larger than what you see there. Off to the right, lots of room to keep growing beyond that. You know, you start thinking about recycling, not a lot of volume, frankly, a lot of it will be within the 4 walls, but nickel sulfate precursor, as far as the eye can see here, pretty much is land that we own, and we've been increasing our footprint here quietly. Where we are today, looking at this facility, we're going to have roughly a $200 million plant when it's done. So to get to production, it's about a $60 million capex US dollars. Canadian government and the Ontario government are both contributing to that. We've got 14 million Canadian in our own working capital, plus the 10 million of government that's to come. And we're working on a $45 million debt facility. I'll get this out of the way right now. I was aiming to have that done before the end of Q2, running a little late, but I'm not worried. It's still coming along well. We're into diligence and documentation, and these things do take a little while. So nothing to be read into that other than it's taking a little longer than we planned. So get the debt financing done here in the next little while, then we're financed, and the project basically comes together targeting Q4 next year for commercial production. And what it looks like is 5 years of feed being provided by China Moly and Glencore, and a 5-year offtake contract. Provisionally, we got a backstop metals trader that's going to take up to 100%. But the idea here over the next 12 months is to enter into some direct offtake contracts with OEMs and the battery makers. And so that backstop agreement starts to draw down. So 5 years of feed, 5 years of debt, 5 years of offtake. And then it allows us to keep growing, whether it be battery recycling, nickel. I think you'll see us able to produce more as we get into production beyond the 5,000 tons that we're showing here today. So it's kind of walk before you run. I'm focusing really on the financing and first production, but there's a lot more beyond that I'm going to start talking about as we start to de-risk the asset. And the first thing, and I started this already, the fact that it's not just a cobalt refinery. So when you start looking at black mass, that's the material you get out of recycling. Now you start to get cobalt and nickel primarily. but there's also opportunities for copper, lithium, graphite, and maybe some manganese. And so that will be what I call a phase 2 expansion. Won't take long. We could probably leach almost immediately and produce at least a copper product. Nickel extraction is not hard, maybe not battery grade, but there is a way for us to grow into what is today a small market. But 10 years out, it's going to be pretty important to us and to our clients being battery makers and OEMs. So get this up and running. If I limit ourselves now to focus back on the cobalt market, this chart on the right-hand side shows you the players. And as you can see, it's a China story, like a lot of critical minerals and rare earths. And you've got Kokkola Refinery, that's Umicore in Finland, the 3rd largest in the world. We would fall into the number 2 spot in one of the top 10 refineries in the world. So important, and that's really helped drive some of the conversations we've had with OEM and supply chain participants looking to de-risk their supply chain. Given the time, I won't spend too much on this, just a number of stats here showing you on the one hand, the growth of EV sales projected, Bloomberg New Energy Finance, kind of growing 25% a year or so, with the next chart over showing what that means in terms of penetration rates, with EVs accounting for 30% of the market by 2030. And lastly, and probably the most important one, just to dispel this idea that cobalt's coming out of the cathode. There are entry-level vehicles, LFPs, we call them, lithium iron phosphate, that don't need nickel or cobalt. View that as an entry-level, sort of a cheaper vehicle. For North America and Europe, for the Western market and the long range, high quality vehicles, you want nickel, and nickel requires cobalt for stability. That's not going to change. Maybe in a lab, not going to change on the road anytime soon. So I'm not worried about that for the next decade. And I think the data backs us up on that. Again, another picture of the asset here. So what this means today, again, sticking just to cobalt, the supply chain, you can see it starts right here in the DRC, if you can see my mouse. And then the supply chain, once it's mined, that's where 70% of cobalt is mined, just about. Once that's mined, it gets shipped to the south. Well, most of it goes to South Africa, shipped out of Durban to China. Some of it, this other line that you can see up into Europe, that's Umicore's facility in Finland. And so what we're doing is we're setting up a new outlet for refined product out of, in this case, out of North America through the Port of Montreal and then up north of Toronto. And the clients that we're targeting, no surprise, North America, yes, but also Europe. Why? Because Europe's, they're a couple of years ahead of us. And I do see some opportunities there. In fact, our vice president of commercial activities is based in Luxembourg. So Michael, formerly ERG, CRU, knows most of these players, and he's going to be guiding that strategy from Europe. So when I look at kind of Q4 of next year, we start producing, where are we shipping, preferentially to these 2 markets, increasingly through time to North America, but North America has got a year or 2 to catch up to build out the battery piece. So there's a good chance some of the clients, some of them are not listed here, but some of the NDAs we have with OEMs would have a ship product into Japan and Korea initially while the supply chain develops. And that's fine. Logistics is not a big part of our cost structure anyway. When you look at our cost structure, I look through time, the last 18, 24 months, the spread between the cobalt hydroxide feedstock that we're buying and then the sulfate product, the crystal that we end up selling back for the precursor manufacturing, is about a $5.50 to $6 US dollar margin. And for us, it's a 236 OPEX that you got to back out of that. Some logistics costs, you're talking 20 cents, and then maybe $1 or so of financing costs for the debt, and you make a pretty good margin. So for us, if I look just purely at the baseline 5,000 ton cobalt project, we're looking at about 35 million per annum of EBITDA before the debt gets taken out. Recycling and Iron Creek get added on top of that. And so again, looking just at that first cash flow, our trading multiples are pretty low. And I think there's a good opportunity for us to re-rate. How, if we're trading at 3 to 5, and we want to become a chemical peer comp at 8 to 10, get the debt done, job one, and then just slowly start de-risking the asset, get our last 2 permits in that are well at hand. But the path is pretty obvious for what we have to do. And I'm a shareholder, so our actions are aligned with the shareholders that are on this call. So black mass, a word on recycling. Small market today, and I guess that's the important. There's a lot of hype, a lot of interest in this for good reason. It's part of the ESG, it's part of the closed loop supply chain that OEMs want. Our opportunity is we'll have a whole plant here, $200 million plant with a full lab, metallurgist, and a team. So our overhead is paid. And so for us to take in 5% of our fee in the form of black mass, we're not going to break the bank with a big capex, because it's already going to be paid for. So we see a first mover opportunity for us in this market. We've done some leach tests. I don't have results that I can share with you yet, but they're looking pretty good. And we had a kickoff meeting this morning on the scoping study part of it to try to pull together a flow sheet scenario using some of the equipment here behind me. And what it means for us. So when you talk about black mass, what is it? So black mass is everything from end of life of the battery to its collection, to removing the charge, to then taking out all the casings, so the plastics and the coil, the aluminum coil, and then crushing that cathode into a black powder, which is black sand, hence the name black mass. Now most of that's going to a single pyrometallurgical plant here in Canada. That's for North America. So it's it's a high temperature treatment. So the environmental footprint's not as good. The recoveries are not as good as well. Hydro plant is cleaner because everything is going into solution, and the recoveries tend to be excellent. And so in China, hydro plants are all the rage. We are already built largely, so we just got to add that capacity to remove the nickel and other elements. ESG, quickly, I've been at this for 20 years. First Cobalt for only 4. ESG, we used to be CSR, right? But ESG is now something more meaningful. It's quantifiable. You're actually measuring your carbon footprint because that gets added into the footprint of a Tesla or whatever the vehicle might be. And so it's been a fun journey for me and a rewarding one. I'll come back to that in a second. For us, because we're here in Ontario, Canada's got one of the cleanest grids in the world. We are getting all of our power off a nearby dam, so it's renewable, it's hydroelectric power. Our carbon emissions of our process are 50% lower than our Chinese peers that are on thermal coal plants. The sourcing of coal, the sourcing of the cobalt rather from Africa, also from a hydroelectric grid. So that drives it down even further relative to cobalt coming out of nickel deposits. And then the markets we're servicing. If we were to ship our cobalt from Montreal, Port of Montreal to Europe, the carbon footprint on that transportation is a third lower than it would be coming out of Shanghai. So nobody's going to have a cleaner product than us. We know that, and our ESG credentials are going to be an important calling card as we market. Sourcing is the other piece. Coming out of the DRC, we're buying from 2 of the biggest miners in the world, 2 of the biggest cobalt operations in the world, and that's how it has to be. No traders, no intermediate producers sort of in between the supply chain, and we can't buy from artisanals. And that's a supply chain that I think can and will get cleaned up over time. We just can't be a part of that because we're a small company, we're far away. We'll let others do that, and we will certify our supply chain through some third-party initiatives that are well-known and endorsed by OECD guidelines and some of the big OEMs and consumer electronics companies. And then the last piece is our Iron Creek asset. So Cobalt's been in the doldrums here for a couple of, it's not anymore, but it was through much of 19 and 2020. And then at the end of 2020, it started to come back. So drilling's expensive, and the market didn't give us a lot of credit for the work we were doing here. So after nearly 2 years of quiet, I guess, we're back at it. And our head of exploration, Frank's built a team in Idaho. You can see one of the access points. We got the benefit of some legacy infrastructure all in the Idaho Cobalt Belt. This belt historically has been explored for copper, and there is copper here, but it's byproduct copper and primary cobalt, which makes this unique pretty much the world over. And it's starting to get the attention, DOD, DOE, you name it. A lot of the conversations we have with government officials under the previous administration have been carried into this White House administration. So the focus on critical minerals, for different reasons, has been continued, and we're pretty encouraged with the I guess the support we see, not so much for drilling, but when it comes to building out infrastructure and plant and equipment. I think we're going to see a friendlier market for capital and debt in the U.S. So asset as it was and as it is today. So Noranda did some drilling here back 30, 40 years ago. We got 600 meters of underground development through 3 adits. We got a road. So really good infrastructure, 2 towns within a half hour here. So, and this is a mining state. We got the former governor of Idaho on our board. Not hard to find talent, and it is beautiful country. Big salmon fishery there. So the water here is sacred, and we treat it as such. And we've got great relationships with our local stakeholders. So our deposit, what's nice about this is you don't have the arsenic in this system that you have in almost all the other cobalt deposits on the continent. It isn't a pyrite, and so we're looking at less energy intense ways of extracting the cobalt from the pyrite. But all in all, it should be an easier one to permit, in part because we don't have the arsenic, but the others were in patented property. So it's private land, it's state level permitting, and we've got a defined resource. As you can see here, it's not quite 5 million tons if I take indicated and the inferred at a cobalt grade of about 0.26. So that's very high grade. It'd be about 5 times the average grade that you might see in a nickel laterite play, and the cobalt values there. And the nice thing is it's continuous as well. We've got mineral intercepts that go up to 30 meters in true width. And so what that means from a mine planning perspective is you can view this as a bulk mineable play, not a selective mining deposit where you're going to suffer a lot of dilution. So a lot more work to do. We delineated this over 900 meters. And if I look on a property scale, it's this red piece that you see in the middle. That's the 900 meters of strike. We think we can double that to 1,800 over the next 2 years. I'd like to double that resource also over the next 2 years. So this summer, as we get back at it, we're going to start drilling the extent geophysics. We're seeing the signature here, both to the west, which is high-grade copper, to the east, high-grade cobalt. We optioned some land to the east where we think this mineralized trend could continue. And we're about to get our permit here on this ruby zone about 1.5 kilometers away, which shows very similar features. Channel sampling gave some great results that could be similar to Iron Creek. So look forward to growing this resource this summer, maybe some new holes here into ruby to see if there might be something new. And then we've more than doubled our footprint here as we get a little bit more serious in the belt. And I would say the ESG investors are quite interested in seeing what we're doing here and maybe participating at a future time. So in a whirlwind, I don't know if I was too fast or too slow there, Chad, but I mean, that's the story. Here's our board, a good diverse board. Susan, head of sustainability for Schneider. Butch Otter, I mentioned him, Hedrick Fisker as an advisor. And then my management team. I should probably mention Mark, who ran the smelter in Sudbury for Glencore back in the day. So we got a good process team that's being built around him as well. I will pause it there, Chad.
That's perfect, Trent. Right on time. And again, I wanted to thank you again for joining us with a unique backdrop. It beats many of us having to do it from our bedrooms or elsewhere. So it's a nice change seeing that we're able to get out there and get in the field. So I'll get the first question that's come in out of the way, because I know you mentioned it. Just kick off the presentation. But again, it's a question on when you think the funding will be done with the refinery. The key question is there anything unique about the due diligence on the technical side? Is there any red flags or anything, or is it's just time?
Yeah. What makes it unique? No red flags. I'll come to that. I guess what makes it unique is the commodity, right? It's not a gold play, not a gold, silver, copper play. So, you're dealing with a bank, traditional bank on some secured debt. And so those of you who have done that, secured debt it's a painful process, right? It's like getting a couple of root canals done where they've got to go through credit committee, they got to go through risk committee, and everything is a memo. And so it's just a long, arduous process where we had outside advisors on the market, on the cobalt market, another one on the legal review, and the other one is technical. And the nature of a brownfield project is great, right? Because we're reutilizing $100 million of infrastructure and equipment, but it also is a tougher diligence process because, is that pump going to be reused or can it be reused? So there's been a little bit of back and forth there. So yeah, no red flags. It's just a long process, frankly, and taking longer than I anticipated. But no, I think everything's going well. The one area where we spent a bit of time, and I think this is now behind us, is just understanding DRC risk. And the reality is, DRC is a massive country. It's 2/3 the size of Europe. There has been civil strife there up in the northeast, sometimes in the northwest, never in the south, where the Cobalt, the Katanga province is located. There's never been an interruption of flows of copper and cobalt, despite strife and occasional warring factions within the country. And I think they've got their heads wrapped around that. Now it's just finishing the technical diligence.
I know near and dear to your heart is the potential for black mass and batteries recycling, and you even mentioned kind of cobalt, not just as a small cobalt refinery. One day it can be expanded, globally significant cobalt refinery, but scale-wise to take on other metals, to have cobalt almost be a battery center. Is that a decade in the future, or kind of how to walk us through your thoughts on that? And I did see you before the talk started, you panned to some interesting equipment, so maybe some of our viewers would want to see that as well. So some tangible evidence.
Yeah. So if I look at the kind of the landscape here, Q4 next year, still our target date for cobalt production. So that is what it is. I think recycling could happen within a year, and even maybe a lot earlier, right? If we think of just taking black mass and leaching it, well, we can do that here. So the feed prep area, feed comes in over my right shoulder, the back corner, as the feed handling is on the outside of that. It comes into feed prep. Over my left shoulder here, again, at the back wall, you can see this white tank. It's actually just in behind that are the leach tanks. Our feed can go in there. We could recover cobalt and nickel tomorrow, almost. We're exaggerating a little bit, but you're probably producing a nickel carbonate at that point. Maybe it's even a cobalt. So it's not quite battery grade, not going back in the battery. So the studies that we're working on right now is, okay, well, how quickly can we start? Kind of get our feet wet. You're adding 2 tons a day on top of the 50. Doesn't matter, right? But you start to figure it out, and then with the equipment here. So yeah, 50% of what you see behind me is going to be reutilized for the new plant. About 25% of it can go into the battery recycling, including this small little lift here, solvent extraction that you can see down here. So this XX circuit is much too small for what we plan to do on the cobalt sulfate side. Perfect for, we think it'd be perfect for the battery recycling for the amount of black mass, because it's an important product and it's getting a lot of market attention, but it's not a lot of volume yet. And so some of this equipment, about a quarter of it, gets thrown into that circuit. So black mass, let's say 12 months beyond the Q4 startup of the cobalt sulfate, and I think we can achieve a better result on that. The nickel piece is a harder one, right? So if we want to get a precursor plant to set up right here with us, why do you want that? Because, and you see it in Harjavalta in Finland, you see it in China. Get your nickel sulfate, get your cobalt sulfate, get your battery recycling, then you want the precursor there. The manganese comes from wherever it needs to come into. Why? Because you no longer need to crystallize your nickel and your cobalt. It stays in solution. It would knock 10% off my OPEX. It would remove logistics costs of having to transport it and bag it. You just pipe it over to the next plant. Lower environmental footprint. You're not shipping it somewhere else. So those are the pieces that belong together. Once you've made your precursor, then you can ship it out to your cathode manufacturer, put it in the battery cell. But that's the concentration of things that you need. Now, what we need to do to make that happen is to understand nickel. There's a lot of nickel in Canada. It's not the cheap laterite Indonesian nickel. It's a lot cleaner, but we need to turn in the processing of it. It might be slightly higher cost, but if the ESG credentials are far superior, that might be okay. So I need to spend time with the team understanding Canadian nickel product and how that feeds in. So, realistically, that's 2+ years away, 3 years away. But you got to play the long ball here. And if we do that, then it all really starts to come together. We've spoken to the government about it. We got $2 billion set aside for these kinds of initiatives. And there's a lot of interest there in working with us.
No, that's great. And I encourage people to look at your valuation slide, which I thought was quite compelling, not just comparing to mining companies, but to chemical companies and others. So that was good. And then, of course, on top of that, the black mass and there's plenty of opportunities for value creation. With that, Trent, we're out of time, but thanks again for joining us remotely. And it's great to see the backdrop there and some progress you're making. So thanks again.
Thanks, Chad. Thank you, everybody. Take care.